today's lesson, guys, is going to be on shorting stocks. What is a short? How does it work in the first place, right? Brokers. We'll talk about brokers too. Brokers that have great shorting capabilities and brokers that you should stay away from if you want to primarily short the market. Again, it's just another edge, right? Some traders are long biased. They like buying the dips for quick scalps, right? Some traders are short biased. They like looking for the tops, nailing the tops, shorting off resistance to the downside. So again, we'll talk about all the different aspects of shorting, brokers, what it really is, get you guys up to speed so you feel comfortable moving forward with shorting. So let's go ahead and start here, guys. We will go right into Investopedia.com. So I like Investopedia.com because, again, it really just gives us the bare bone basics of, the definitions, the terminology to a T. And this is going to be the most accurate information that you guys get. Short stocks. And then the first one that usually pops up is Investopedia. Short selling. Right? So what is short selling? Well, short selling is an What? Okay, threw me off. Starting fresh, starting over. Short selling is an investment or trading strategy that speculates on the decline in a stock or other security's price. It is an advanced strategy that should only be undertaken by experienced traders and investors. Let me hit on that. Why is it a strategy that only advanced traders should get into? Well, here's why. Let's say you have a stock at $1 and you're long. What's the most that you can lose? Your investment, right? That's the most that you can lose is your investment when you're long. Because if that stock goes from $1 and bankrupt to zero, you're out, you're gone. You lose your initial investment. Shorting. Why is shorting risky? Well, because how high can the stock go? Right? The stock can go as high as it wants to go. The sky's the limit, right? So long, your risk is defined. The stock can only go to zero. But if you're long at if you're short at $1 and stock goes to $1,000, that's when you get margin calls. All right. So you've seen the horror stories, you've read them, you've seen them, all the crazy stuff where traders went short, the stock ripped and ran, and they lost $20, $30, $40, $50,000, their entire life savings. So it's very, very risky, and it's for advanced traders. Number two, that's also why you have to have a margin account to short. You cannot short on cash because, again, if you short $1,000 worth of stock and the sky's the limit and it gaps up to 100 the next day, it doesn't make sense. What are they going to do? You only have $1,000 in the stock and $1,000 in your account. Where are they going to get the rest? I mean, it doesn't make sense. So that's why shorting has to be done on a margin account, all right? Because you have to have that margin capability to take a short position, all right? So again, moving on, it is something that only advanced traders should really get involved with. If you're a new trader and you lack discipline and you lack having plans and you can't cut your losses, the last thing you want to do is throw 10 grand into a short, right? Swing it, whatever the case is, it squeeze, you don't sell because you're scared and you can't manage your risk properly. You don't want to get a phone call from your broker. Hey, Josh, so you shorted this stock, ANY, 10 grand, but now we have a margin call. So basically your account went negative $10,000. We had a margin, you had to liquidate your position. We had to automatically sell it because it exceeded our margin requirements. But now you officially have a margin call on your account and you're in debt to us for $10,000. That's why it's very, very risky. So again, if you're not the type of person that can cut your losses, if you're not disciplined, you can't manage your risk, I would stay away from shorting for now. Paper trade shorting, right? You could short on paper, all right? You can simulate it. But to identify a strategy that works for you, something that you like to do when it comes to shorting, and again, start getting the foundation built of your trading when it comes to the basic stuff, but the most important stuff, again, that discipline, risk management, trade plans, everything that we really focus on and that we force into your head every single day. All right, guys? So traders may use short selling as speculation, and investors or portfolio managers may use it as a hedge against the downside risk of a long position in the same security or a related one. Speculation carries the possibility of substantial risk and is an advanced trading method. Hedging is a more common transaction involving placing an offsetting position to reduce risk exposure. So again, when you have a lot of your hedge funds, traders will do this as well. They will hedge. Again, hedge fund, they will hedge. So they'll take Apple and they'll go long and short to where they know they can have predefined risk on every side. So no matter which way that stock goes, they're still going to win, right? They're long and short. But they're going to stop out on one side or the other. They're hedging their position. So no matter which way the stock goes, they're still making money, right? They're still going to be profitable on the trade. We will hedge options sometimes in chat, depending on if it's a really good setup and the options make sense. You will see us taking calls and puts. You're hedging your position, right? But the thing is, you're still predefined on calls and puts, right? So your risk is predefined on the call and the put. So the put, you're technically shorting the stock, right? Yeah, a put. You buy a put when you expect the stock to come down in value. But again, the only thing you can lose is your initial investment, your initial, the contract value. The lowest it'll go is to 0. So again, if you want a more conservative approach to shorting, and there's a stock that you like, and you want to short it, and there's options available, you can have predefined risk by shorting options, basically buying puts. All right, and puts are going to appreciate in value when the stock comes down. But again, more advanced traders short because, again, there's a lot of risk to it when you're actually shorting the shares of a stock. Now, how do you even short shares of a stock, right? How do you short shares? Well, basically, your broker, so let's say TD Ameritrade, your broker has an abundance of shares on MXC, right? And you want to short it. So they're going to loan you these shares. So let's say you want to short 1,000 shares of MXC at $14. They're going to loan you 1,000 shares that are going to be sold at the current price. They're going to be sold right then and there, right? So you're in debt for 1,000 shares. You have to rebuy those shares back. You have to rebuy them, right? Because right now your broker gave them to you, they're short. I mean, they're gone. You sold them to the market, but you still have to give them their shares back, right? You have to give it back to them. They want their shares back. So you got to rebuy them, right? But you want to rebuy them at a lower price, of course. So if they're sold to the market at $14 and you rebuy the same 1,000 shares at $13.50, what do? You return the shares to your broker, but you bought them for a less price. So you get to keep the difference of profit. Does that make sense, guys? Hopefully it does. So again, they're loaning you the shares, but you don't actually have to physically sell them. They're going to be sold automatically to the market, but it's still a loan of shares sold to the market, and your goal is to buy them back cheaper than what they were sold at, to where when you return those shares to your broker, the fact that you bought them cheaper, you get to keep the difference, plus a little bit of a fee, fees and whatnot to the broker. But that's the ideal goal. But if they're sold at the market and you have to buy them back more expensive, you still have to return the same shares, but now that you're buying them back more expensive, you're out that money. So that's how shorting works, is it's a loan. You're getting loaned the shares to short, and your goal is to buy them back lower, which is called covering your position. When you hear short traders say, I'm covering here, or this is where I'm looking to cover, right? They are basically looking to rebuy their shares. So again, shorting, we understand what it is. We know that it's very, very risky. The reasons why, right? Because that stock can go from $14 to $140. Yeah, eventually, your broker's going to step in and liquidate the position, but you would still be in debt to your broker if you got caught up in a short squeeze and you never sell your position. So very, very risky. The reason why a lot of traders are long biased, because the stock can only go to 0, right? The stock can only go to 0. You're only going to lose X amount of dollars, okay? Moving on. Let's talk strategies, all right? Again, we talked about the basics, what the shorting is, how you short in the first place. Actually, let's dive into brokers. Let's talk about brokers for shorting, right? As we know, TD Ameritrade, the most popular broker out there. Many, many traders use it. Not very good for shorting. Almost 90 to 95% of their stocks are hard to borrow, which means you got to call them. Hey, can I short this? Oh yeah, hold on, let me check. Yeah, you can for, a fee. All right, what's the fee? $200. Okay. You look, well, the stock Okay, well, I'm not going to short it now because, I wanted to short it there, but I'm not going to short it now because it took too long. TD's not good. You can't go in and locate shorts through TD. TD, almost 90 to 95% of their stocks are HTB, hard to borrow. 5 to 10% of their stocks are maybe easy to borrow, which means that you can short without needing your broker's permission. That means if you go sell the market, you're going to immediately be in a short position on an easy to borrow stock. Why do I use Lightspeed? Why have I used Centerpoint Securities in the past? Yeah, they require more minimum deposits, at least $25,000, but why? Because they have an easy to locate tool, right? So basically if it says hard to borrow or locate, you can easily go in and locate them, accept the fee right then and there. You have your shares on standby. You can short them at any point in time. Boom, 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 done. And they have a bigger abundance. They have more stocks that are easy to borrow, which means I don't have to go through the locate process. I don't have to pay fees to locate them. I can basically sell right then and there, and I'm automatically short in my position. So again, brokers that I would suggest not using if you want to primarily short, I would not use TD Ameritrade, right? I would not use TD Ameritrade whatsoever. I would not use E-Trade. I would not use Interactive Brokers, right? I wouldn't use any of these big time brokers, right? I hear Weeble's okay for shorting. But again, I'm not a big fan of the mobile app brokers, like the ones that started off mobily, like Webull and Robinhood. I'm just not a huge fan, right? I want someone that's been around, that has a proven track record. For whatever reason, I'm just not a huge fan of the mobile brokers, guys. So again, a lot of your big time brokers, like your E-Trades, your Interactive Brokers, your Schwabs, your TDs, if you want to short and short only 90%, I wouldn't go with them. What I would look to do is do Centerpoint Securities is my number one pick. Centerpoint Securities, and they use the DOS platform. And then you also have Lightspeed, and you have multiple platforms you can choose from with Lightspeed, but they're very, very good with shorting as well. A lot of easy to borrow stuff. So again, the yeses and the nos as far as brokers go. And then strategies, guys. To make it very, very simple, there's two approaches that I take to shorting. I'm 70% long biased when it comes to physically trading shares of a stock, right? Because I do a lot of options, but options is a different ballpark. But when it comes to actually physically trading, right, I'm like 70% long biased. Now I will short stocks. I will short. You see me took a short yesterday. Two ways that I short, right? The first way that I short is the same way I go long. What is that? Well, when we see a big move to the upside and it pulls back quick to support, what do I like to do? I like to go long for the bounce. All right, so if we see a big spike to the upside right into an area of resistance, what do I know is going to happen? The stock's going to pull back. So I like to short the tops, but I have to have multiple reasons to go short. If it's been tagged one time and there's not other pieces of validation like other areas that stock has had resistance, I'm not going to short it because the odds of it pushing through are easier. So if I have VWAP, right, and I have resistance from prior support that I know, like, okay, well, if we come back up, it should be held down as resistance. We have VWAP. We have a moving average, right? We have different pieces and different validations that, hey, this is going to be a strong area for the stock to get above, and we see that big time spike into resistance. I will go short and I will cover lower. And at the same time, I'll flip position. So if I'm short and it pulls back to an area that I would like for a dip, I'll flip long and take it right back up, right? So I really like doing that. So again, my strategy for shorting is the same strategy I have for going long. It's just the complete opposite. I'm no longer buying the dips. I'm just shorting the tops, right? Valid areas of resistance to short off of. Valid, valid, valid. And every single time, where's my stop? My stop is going to be right above that area of resistance. Right above. I don't want to see it go higher. I want to see it get rejected right there. And I want to see it pull back. If it starts squeezing, that shows the buyers still have some strength left in them. And I'm not going to go ahead and take a chance of getting caught up in a short squeeze. So that's my strategy, number one, for shorting. Another one I like to do, you guys see this a lot, is when the market's slow. What do we normally see at like 11, 11:30, 12, 1, afternoon? What do we see? We see random low float penny stocks getting pumped, right? There are communities out there. There are traders out there that will just go find one of these stocks. Like, okay, what do we have? All right, SFET. It's only up 10%. 165 million in float. Let's start pumping it, team. Let's pump it. Pump, pump, pump. And you'll see it, right? There's no news. It's barely up. And it goes from no volume to out of nowhere getting 100, 200, 300,000 shares of volume. $1.50 all the way to $2.50. What does that create for newer traders? FOMO. Oh my God, SFET's hitting the breakout scanner. Chase, 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 buy, 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 buy. Why is it called a pump and dump? Because traders and groups will pump it up and have everybody else follow along just to dump it, right? So when I see these low float pump and dumps hitting the breakout scanners, the high day momentum scanners, I'll wait until I see the exhaustion on the bids to where I don't see as many more buyers. They're exhausted, and I'll go short. My stops are super tight. I'll go short, and I'll wait for the dump. And those dumps are just as good as the pumps up. So sometimes you get those $1, $2 pumps. Those dumps are just as good to the downside. So I love shorting those, especially when they're easy to borrow. So I would have to say that's probably my go-to. Now, do I short that every single day? No, because we're not seeing low float pumps every single day. But we do see them, and those are the easiest, most, it's great. That's all I can say. It's great because odds are so in your favor that it's going to come back down. The reason that they're called pump and dumps, right? So those are great to short, low risk, high reward. Okay, guys? So, AJ, that's why penny stocks are worthless and meant for shorts only. I agree to disagree. Penny stocks are worthless. There's a reason why they're cheap. The companies aren't great, right? But we have seen a lot of these penny stocks go absolutely nuts to the upside to where we've seen big time short squeezes, right? The shorters that have that mindset is, oh, it's crap, I'm going to short it. And we've seen the stock go from $5 to $50. Now, yeah, they come back down, right? We're not long-term investors with penny stocks. We're not long-term investors to the long side or to the short side, right? I'm not going to invest in a penny stock, period, whether that's long or short. I'm going to take advantage of the opportunity that I see. But the last thing that I want to do is get into a short position and get squeezed on. And we've seen that a lot the last couple weeks. Big time short squeezes because shorts are just trying to nail tops, but there's too much buying momentum behind them, and you can absolutely get crushed. They make me go, oh, when I'm on the right side. Yes. So guys, this is a good time for a Q&A, all right? Ask some questions if you don't understand anything. But again, we talked about the basics. What shorting is, how people utilize shorting, whether that's to hedge a position, if it's speculation, right? Us day traders, how we day trade shorts, how we short technically large caps with low risk, that being options, puts, right? So we talked about a lot, and it may be a little overwhelming, so you can ask any questions, right? We talked about how does this short even work, right? They're shares that you're borrowing that you buy back at a lower cost. That's the goal, right? So buy those back at a lower price. My strategies, how I like to short, right? My most success is out of the pump and dumps. So a lot of information out there. Hopefully it answered your questions as far as when it comes to shorting. And for example here, if you want a live example on MXC, if this was shortable, there were a few times that I probably would have taken a short. The simple fact here that we have resistance. I'm not short yet. Why? Because this could be a third touch breakout. We have higher lows still. So if I'm looking at this for a possible short, I want to wait for the confirmation of weakness in the lower low. So right now I'm thinking, okay, here's our low, here's our low, here's our low, here's our low. So I'm looking at all these lows. So right now, if it breaks above 1463, it's long, obviously. If we crack down below 1356, I'm thinking short. Why is that? Because that's our low right here off this candle. If we're looking at all the previous lows, where else is that? Well, that's our previous area of resistance, which should hold up as support. So if we start losing this low, we start losing this area of support, right, which was prior resistance, I could look short to cover down towards around the spiking highs, where I would probably cover. I'd look for about 50 cents. So if I'm looking at this for a short, I'm waiting for the crack and the confirmation. So I would have been ready to go, and I could have taken that short. It was getting weak, right? Look, it was getting really, really weak. It wouldn't break out. I knew where my entries and my exits were. I know my plan. I have an order ready. Boom, boom. I would have made more money than I wanted to, and you get out quick, right? So that's how I would have gone about a short on something like MXC as far as mapping it all out. Where would you make your entry anyway? Would you be shorting it right here, Josh? Fuck no, I wouldn't be shorting it right here. Why? Because it's still bullish. It's still building higher lows until we confirm a lower low and we show weakness that we can't get through. I'm not going to short it. I'm not going to get squeezed $2, $3 to the upside. Screw that. I'm going to wait, right? My mindset is I would rather be a few seconds too late to the trade than a few seconds too early. Because if I'm a few seconds too late, that means I was extra patient and I waited for the utmost confirmation. But if I'm a few seconds too early, sometimes that means I'm buying into anticipation of something happening and we haven't really gotten 100% confirmation that we should take the trade in the first place. So it's always best to be a few seconds too late than a few seconds too early to a trade. So in this case, if I really wanted to short this, I would have short orders ready, right? I can have a limit for a short at a certain price, sitting in the background, sitting there. And I would have been filled on the short, and immediately I would have gotten out. And I would have made a shit ton of money. So that's how you kind of go about it, guys. That is not correct either, AJ. No. We've seen stocks rip and run, right? Stocks can go up just as fast as they can come down, right? So not necessarily shorts make you money faster. It's all about, again, how many dollars or cents per share. Again, we've seen stocks go up just as fast as they've came down. Can't tell you how many times I've seen a breakout, right? I've seen a breakout be like a $3 breakout to the upside. I'm like, whoa, that was a great breakout. And I can't tell you how many times I've seen a dump be, $3 to the downside. So I would say you're 50-50, right? 50-50. They can both move the same. Depends on the stock, the float, the volume, key area, support, resistance. If an offering comes out, if a midday press release comes out to the upside, the downside, there's just a lot of variables, but they're going to be very similar. Stocks can go up just as fast as they can come down. Absolutely not. 100% no. Why? The market's just a world of unforeseen variables, right? The market's, you can't predict everything in the market. What do I mean by that? You can predict patterns and setups. Okay. What if a company issue an offering right now? What if they issue an offering right now? The stock's going to dump big time, right? That's an unforeseen variable. That's something that you cannot predict. We don't know that they're going to issue that press release, but let's say they do, right? So why would I short something? Let's say I'm short and they come out with the world's best press release. Fantastic. Oh my God, whether it's fake or not, whether that's bullshit or not. And they come out with the world's best press release. And that stock goes from, closing at $5 and it gaps up to 30 the next day. Screw that. I don't want to wake up to a margin call. I don't want to be in debt to my broker. Because if it closes and you're short and it gaps up that much, they're immediately going to sell you at that $35. They're not going to wait to see if it comes back down. They're closing that position. You can be negative tens of thousands of dollars. Look up world's worst shorting stories. And you'll see a guy that was shorting something. Something happened. Good press release, gapped up. He lost $120,000. He lost his entire savings because he shorted a stock because the sky's the limit. Will I go long swings? 100%. Why? Because if the company goes bankrupt tomorrow, I'm only losing what I'm investing. I have no more risk than what I'm investing. But he like $120,000. So I will never, ever, ever short physical shares overnight. Will I buy puts, right? Puts, shorting. Will I buy puts and swing those? Yes, because my risk is predefined. The lowest that can go, the value of that put is to zero. So if I buy it for $100 at $1 for the contract, it goes to zero and expires worthless. I'm out $100, right? I'm out $100.